Hey, what's up, everybody? It is Crypto in the House. Today is September 13th, and I am going to talk with you about the Fidelity news that are we going to finally see Bitcoin trading? Secondly, we're going to go over Ethereum and the merge and the outflows that are occurring. Is that cause for concern? And finally, we're going to end up with some real estate and where some top markets could be suffering even more. So I'm going to jump right into the first story. I do crypto and I do real estate, the most important stories of each day, so you don't have to look them up for yourself. Wall Street Journal comes up with this: Fidelity weighs Bitcoin trading on brokerage platform. The firm has more than 34 million brokerage accounts. So basically, they're saying they might soon be able to buy Bitcoin via the company's brokerage platform. They have obviously 5 trillion in assets, one of the world's biggest asset managers, and 34 million individual investors. So they are giving their clients the ability to buy Bitcoin directly. So basically, they provide management services, including mutual funds, pension management fund platforms, private and institutional investors, stuff you probably already know, but Bitcoin trading could be very, very, very big for the space. Moving into some interesting news on Ethereum. Investor jitters over the merge. This is according to CoinShares. Digital asset investment products saw total outflows of 63 million US, the fifth consecutive week of outflows. The outflows remain relatively small in size, basically totaling 99 million over the last 5 weeks, with volumes remain only 46% of the year's average 1 billion for the week. Ethereum, however, was the primary focus of the outflows, totaling 62 million last week. Okay, so that comes despite the improved certainty of the merge and perhaps highlights a concern among investors that the event might not go as well as planned. So we will see how the official merge, how it affects everything. But for now, there are a lot of outflows going on with Ethereum, so we will watch that closely to see what exactly happens. Speaking of down, Terra Luna, according to Decrypt here, Luna sinks 38% from the recent high. We all saw this sudden surge of activity in Luna and Luna Classic. They're still way up and overpriced from last week. But again, the price of Luna has fallen 38% since last Friday's surge. And the Luna Classic has also dropped, but both have gained a lot of value still over the past week. Moving into Celsius. Celsius plans to restructure the firm to focus on your crypto custody. Alex Mashinsky made the announcement on September 8th, in which he discussed a possible scenario, basically forming a new company. He and his chief compliance officer want to revive the company using the name Kelvin, which would store crypto and charge fees on certain transactions. He made the announcement again on the 8th to an employee meeting, and discusses possible scenarios after the July bankruptcy filing. So maybe you want Alex Mashinsky and them to custody your coins for some sort of I don't know what, but maybe you do, maybe you don't. But he will look into that under this company called Kelvin. Starbucks. Okay, Starbucks has teased this for a little while. They're finally releasing some details about this Starbucks Odyssey. Later this year, the coffee company is going to enter Web3. The new experience will be a Starbucks. If you've been to a Starbucks, you know there's the loyalty rewards you get on your app, and then you can use those rewards for whatever, drinks, food. But they're going to basically combine that with their NFT platform, so customers can earn and purchase digital assets that unlock exclusive experiences and rewards. Again, as stated, they had earlier teased the Web3 plans, saying that this would build on the current rewards model where you earn the stars in exchange for perks like free drinks, but they want to envision this Odyssey platform as a way for loyal consumers to earn a broader set of rewards while also building this Web3 community. So who knows? We'll see what happens there, but pretty interesting news if you're a Starbucks fan. Moving into some real estate, right? So here's Realtor.com. The areas, U.S. metros where homeowners stick around and the ones that they want to get out of. So basically, they looked at CoreLogic, the real estate data provider, data from January 2001 to August 2022. Median number of months that passed between the most recent home sale and the previous time it changed hands for the largest U.S. metro areas. They excluded some areas because their sale data doesn't go back that far, but the large majority of metropolitan areas, 71 of the top 100, were included. And basically, they only included one single metro area in each state, except in the case of a tie. So here we go. Top 10 of the areas where homeowners stay the longest And on the right, you're going to see the areas where they stay the shortest. So kind of interesting here. I mean, you'd figure New York City, Miami, Washington, D.C., places like that would be probably income based, where, they're staying the longest because they're working in government jobs or Wall Street, or millions of potential jobs you can get in New York City. Albuquerque, has a booming film base. There's a lot of auto. Cleveland, obviously. Going on to the other side, when you look at the people that want to leave, you see your Knoxvilles, you see, Oklahoma. What really surprised me here, I could see Knoxville, maybe colleges, Greenville, maybe college based again. Atlanta, what really did stick out to me was the shortest was Phoenix. Maybe there's, again, going back to 2001, probably a lot more now to where you're seeing people who moved there because of the boom we all saw in the last couple of years. People wanting to get in the Phoenix market. I don't think they're getting out of there as quickly as they were maybe in the last decade or so. But there you go. There's basically the 10 areas where people stay the longest and 10 where they leave the soonest. Last article here for Fortune magazine. Home prices are falling in 98 major housing markets. Only 50 markets remain at the peak. So basically they're saying these housing recessions are historically common when the Fed fights high inflation. Home prices corrections are not so much, but home prices are falling in 98 markets. So basically they're saying that of these 98, 11 of them dropped even more than 5%. So the home price correction is sharper and more widespread than predicted. When the last housing cycle rolled over, home prices didn't fall until inventory levels skyrocketed. But now home prices are falling despite inventory levels sitting 41.5% below. We don't have a lot of homes on the market. So you're seeing this sort of inflation, but you're not seeing the skyrocket in number of listings. We're seeing a lot less listings on the market right now. So the two groups that got hit the hardest were high-tech hubs, San Francisco, San Jose, Seattle. And then they're calling these frothing markets, Austin, Boise, Phoenix. So obviously the tech, a lot went to Austin, Texas. A lot went to, many different areas throughout the country. But as we see, Austin even got hit. A lot of Californians left these tech areas and then went to Austin, Boise, Phoenix, as we just mentioned Phoenix in the last slide. So those are the two hardest hit places. 98 markets have fallen at their peaks, but another 50 have yet to fall from their 2022 peak price. Even though some of these remain flat, it doesn't mean they won't fall. In fact, home prices could be falling in both 2023 and 2024, according to John Burns Real Estate Consulting. Moody expects the home prices to fall up to 5% if in overvalued markets, maybe these San Francisco, Seattle's, it could be 5 to 10. If a recession comes, which depends who you talk to, whether we're in one or not, it could be 5 to 10 nationally and 15 to 20% in these overvalued markets. So that would be very interesting to watch if you see a Seattle getting a 20% drop in their housing price, because that would not be good. However, U.S. price drop probably won't be as bad as during the last housing downturn between 2006 and 2012 when they fell 27%, but that is yet to be seen because we are not in those years yet. I personally think we still have a lot more to go. We are seeing these houses sit on the market for a long time. We're seeing price drops. We're seeing people take less money. We're seeing sellers hesitant. We're seeing buyers with less competition, which they like, but the interest rates are so basically outrageous for most people, almost double from last year. They're reluctant to buy. So you have this situation where the inventory is not there. You have this recession that some people want to say we do and we don't have. You're seeing the sellers who are hesitant because they know there's going to be a lot less offers on their house. And then you see the buyers that come in thinking they can sort of dictate the transaction, but because they don't want to pay that much, or, with their interest rates, you're seeing a lot of adjustable rate mortgages. People are taking more risk right now for obvious reasons, but we will see how this all shakes out in the future. But those are the stories I thought were the most important to share with you all today. So those were the crypto and the real estate news for today. I do these live streams every day. So consider liking this video, subscribing to this channel, checking in with me every day. Hit me up in the comments and let me know what you think. If you like, again, crypto and real estate, I try to focus half the show on each and give you the most important stories in a condensed version so you can take a look. And all the links will be in the description. And let's connect online. Hope you all have a great rest of your day. I'll see you all tomorrow.